In this, I want to go over like kind of just how the market moves because I feel like this is something that's not a lot of people understand. And I feel like if you understood it, like it's honestly very simple, but if you understood it, like ICT concepts would like make a lot more sense. Like a lot of people shit on ICT concepts, but they don't understand because like they don't understand them. Like they're built around like how institutions trade. They're built around volume imbalances. They're built around inefficiency in the market. And like people that like claim they've been on Wall Street for 30 years and everything about ICT is bullshit. Like, no, you just didn't spend time learning it. They're like, oh, you invented the word fair value gap. You think fair value gaps are created by inefficiencies in the market. And I'm gonna show you guys all this, but I just think people need to spend more time on actually learning like the why behind something. I feel like I'm seeing a lot of inverse fair value gap traders, and there's like people that expect price to, just bounce off the fair value gap every single time. Um, and just like I don't know, I see a lot of people talking about ICT comps that's like fair value gaps, order box, uh, highs and lows, and like I want you guys to understand like what's actually happening at these levels, and like what even is a fair value gap? Like what? All you can tell me is it's a if a candle. Right, wick. Is there an uptrend? Fuck. So this is our candle. Oh, shit. I'll say this is our candle. There. Really good at art, by the way. Oh fuck. That's our next candle. All you can tell me is that it's that gap. You can't tell me what that gap is, right? And that's an issue in trading that I've seen, like just not understanding the why behind things. And I feel like clearing that up would be very important. So let's start with um limit orders and market orders. How does the market actually move? What is actually happening when price is going up? When price is going up, you have sellers and you have buyers, right? And you have two types. You have market orders and you have limit orders. You have aggressive buyers and you have passive sellers. So you have aggressive buyers and you have passive sellers. Aggressive and passive. What's passive? So let's say we're in an uptrend. We have a high here, right? And um, this is where we are currently in price. Passive sellers, passive buyers are people who think we're going to hit this level. Let's talk about passive sellers. We're going to hit this level and we're going to go down. So they're going to place, it's called a limit order. You trade, you know what this is, like you're going to place a limit order at this price to say if price hits this level, we're going to react bearishly off this level. So you're just essentially placing an order um, and waiting for price to go hit that order. And market orders are saying, um, oh, we're in an uptrend. I think the price is going to continue to go up. So I'm going to try to get in at the next available order, and it's going to look for people that are selling to buy from. So it's going to look for limit orders placed along this area, and the next limit order that's available for that amount, it will buy at that price. So let's say the price is at $91 right now, and there's 20, I don't, this is unrealistic, but there's 20 limit orders, and this is $92, this level. There's 20 limit orders in between this area, and you want to buy 10. If you buy 10 orders, you're going to get filled at 91.50. Instead of if you had a limit order at 91 when price hit, for a buy, you would get filled at 91. So that's like the kind of like the slippage in market orders. And the reason for this is the market orders are the orders in the that actually move the market up and down. Limit orders, if there were only limit orders in the market and only people placing limit orders, the price would not move. It literally would stay still. It would not move because all these limit orders would just be waiting for price to hit this level. There would actually be no reaction going on in the market. So every time you're seeing the price moving, that's literally just a battle between aggressive buyers and aggressive sellers. And when you hit like when you hit a key level like this, the reason price might react off of it or just like or stall or react reverse off of it like that is because there's all these limit sell orders being placed at this area, right? So you hit this, and I think that's why we wait for confirmation, like because we don't know if we're gonna hit this level or we're gonna consolidate, and then that kind of means we're accepting price at this level and we're gonna continue up, or we're gonna hit this level and then we're gonna reverse because there's limit orders, then we get a switch to aggressive sellers, right? Aggressive sellers push the price down. So it's all about waiting for the confirmation and understanding that there are limit orders at the highs and lows, and that's why you expect liquidity to be there. That's what liquidity is. It's resting orders. Banks call liquidity resting orders. So when people shitting on ICT concepts are like, "Oh, I'm gonna trade liquidity," like they'll be like, "Bankers don't even know what liquidity is." Yes, they do. It's just a different name. It's called resting orders. That's why you're trading. You're trading these resting orders, resting sell orders, resting buy orders. So when you see an asset come up and like not manipulate it, that means there wasn't that many limit orders, and the aggressive buyers were kind of just like they got absorbed, but the aggressive buyers remain strong, and it's likely to be a continuation. You likely will get some retracement back, and then you'll get another. You either get more absorption or you'll see aggressive buyers win. And when it reverses, what are you seeing? You're seeing the price go up, get absorbed, so you get a reaction off the bat, and then you're seeing a switch from aggressive buyers that were pushing the price up into this high. You're getting a switch. So once all the limit orders have like done their part, you got to see a switch from aggressive buyers to aggressive sellers. So the market starts to believe that we're going to reverse, and aggressive sellers step in and push the price down. And once you get that confirmation, maybe a little retracement. Once you get that confirmation, you can expect the market to go down. So to review, what is happening? What moves the market orders, and what orders are being placed on key levels? That's the limit orders. Who is placing these limit orders? The passive buyers and sellers. And who's placing the market orders? The aggressive buyers and sellers. So when you're in the middle of like highs and lows, like you're just looking at the battle between aggressive buyers and aggressive sellers. And when you hit these key levels and you see the reaction, either consolidation, the trades right through, or it reverses, then you're seeing kind of the battle between again the aggressive buyers and the aggressive sellers after it hits. Like the market is trying to decide where it's going to go. That's why a lot of the times you'll see the market hit, and let's say it's going to reverse. It reverses for a second, comes back and retraces, and then goes a little deeper. More orders are getting absorbed here. Like people have limit orders a little above price just in case to get the price more at a discount, and then you'll see the price start to go down. So absorption is very important. Um, and adding order flow to your trading style is like you're not just going to be an order flow trader. If you're watching this video, you probably trade ICT. Like you're not just going to be an order flow trader, but seeing the market get absorbed. We have buyers getting absorbed by sellers. Let's say you're trying to trade a reversal. You have buyers get absorbed by sellers, and you see the switch from aggressive buyers to sellers at this on this move down. That can just add confirmation to your trade. And I'm not saying it should be the only thing you're trading, just looking for order flow concepts, but that can add confirmation to maybe, an SMT, like another asset. Oh shit, another asset's like down here. This is confusing, but okay. We have this high, and this asset takes out that high. Another asset's down here. And what do we see on this? The same thing. We see absorption and we see a switch to aggressive sellers. That can just be more confirmation on top of your SMT, on top of your two-stage PSP, on top of your order block CISD confirmation. Like, you know what I'm saying? Like, you're kind of stacking these things up and creating more confidences for yourself and getting a higher win percentage, hopefully, using this. Um, so that's how the market moves. Like, the the aggressive sellers and aggressive buyers are purchasing passive sellers are purchasing their orders from passive sellers that are at these levels from passive sellers and passive buyers. That's why when you get into a market order, like you might click the price at 91 and you might not get filled till 93, right? Because there's an inefficiency at 92. There was no limit orders placed there. And that's where we're going to get into the fair value gaps. So looking at the fair value gaps, this is primarily based on volume. So in an efficient market, at every level of price, in an efficient bullish market, price would look a little bit like this. Little retracement, orders get filled, little retracement, orders get filled, little retracement, orders get filled, right? In an inefficient market, we look like this. Go from consolidation, break through this level, and we look like this again, right? This is an inefficient market. Why is this efficient and why is this one inefficient? And you're like, oh, we see this all the time. Yes, the market is inefficient a lot. That's why these fair value gaps are created. Um, let's say, for example, this we're literally looking at a candle made for each one of these moves. So one, two, three, 10 candles, whatever in this move. Um, the market moves up, uh, aggressive sellers and then buyers that like miss this move that want to get in are able to get filled here, and sellers that want to get in like are able to get in, and then they get stopped out, and then it gets moved up, and then so buyers that miss this move that want to get in get filled, people that are missing these orders, and it's just an efficient market. It's efficiently moving. Um, everyone's getting filled. It's just like you're getting filled at every price. Like there's no inefficiencies. There's no areas where orders weren't able to be placed. Like if you wanted to get in an order at, let's say this is 93 right here, and you missed it on this move, oh, it comes back and now you're able to get in the order. Whereas here, let's say people were looking to buy, right here, price rips through, never retraces to that area. Price actually just rips through and then it creates all these fair value gaps in doing so. Because why? It's creating an inefficient market. Price never, like, there's buyers that want to get in at these levels. What does price do? It never retraces to these levels. And there's an absurd amount of aggressive sellers. And also, what did we just talk about? Limit orders, right? And where do these come into play? If there were limit orders at these areas, price would trade into these limit orders and then it would reverse. These limit orders would have effect on the price. But these are in areas of low volume. When this happens to price, it goes from high volume areas where there's a lot of chop and price is bouncing around, trades through a low volume area where there's no resting orders that are fighting price. And it trades to another high volume area. And that's when you get these fair value gaps. So like this kind of helps you just know which fair value gaps are like very relevant and can kind of just tell you that price is expanding fast a lot of the time. Like a lot of the time, you're not just gonna watch it trace back into the fair value gap and automatically get respected. Like the fair value gaps are kind of telling you more of a narrative of like is price expanding one way or is it expanding the other way? And if you're getting fair value gaps, you know there's an overload of aggressive sellers or aggressive buyers that moved the market that way and just completely ignored all these limit orders, or like was so strong that it traded right through all these limit orders, or that there just wasn't enough resting orders to even combat like all the aggression. So what it will create here, we'll probably have a fair gap there, fair gap there, fair gap there, all these fair value gaps being made. So that's what is actually happening. And oh yeah, if you pull up a volume chart, what's going to be happening at this level, you're going to see high volume right here. You're going to see high volume right here, right? So this is volume analysis. This is what you're looking at. There's a high volume right here. There's a lot of trades being placed here. There's a lot of action going on. There's a lot of resting orders. When we trade up into this area, what's happening? We're hitting a lot of resting orders and we start to consolidate. Where are we coming from? We were in a consolidation, then we get breakout. We're in a consolidation, we get a manipulation, buyer step in, they get a price at a discount, forces the price to go up. We break this high volume node, we trade into what? Low volume nodes. There's no orders really being placed at these levels, and price just trades quickly to this next high volume node. And I think this is really effective in like swing trading from the week to week basis. Intraday, not so much, but that's a personal thing for me. I know a lot of people that successfully trade volume and order flow combined. Like literally just these two concepts combined and make a lot of money. Search up Fabio Valentino. That guy is legit and he posts his stuff live and he's a really good teacher if you're trying to learn more about this stuff. But I'm trying to relate it to ICT concepts, not just have you trade volume and order flow. But pretty much like that's what you're looking at when you see a fair value gap. It's either because it's trading through a low volume node and there's no limit order stopping it, or it's because there's like too much, there's just an overly amount of aggressive sellers or aggressive buyers in the market, and it's just disrespecting all these limit orders. It's like, getting absorbed and just continuing through them. So, yeah. What's another thing we can look for when we hit a high? This would be trapped buyers and sellers. This is important because let's say you come up and hit a high, and you kind of go back down. Um, so like we hit this high, we get absorbed for a second, right? And then we kind of retrace, but the move is going to end up going bullish. This can work both ways, but this is the example I'm going to give. The move is going to end up going bullish. But we hit this high, we kind of retrace, like we get absorbed for a second, but we never get that switch to aggressive sellers. So the market ends up going bullish, right? All these people that got in sell orders, like saw it kind of coming back up to here, gets the resweep, this high or, this short-term high right here. All these aggressive sellers, god damn, are getting in this trade. They're either placing their stop and getting in right here because they're expecting it to respect this level and continue down, or they're placing the stop like right up here. They're getting in at this level. All these aggressive sellers are getting in, and buyers that are holding this level and trading through this. So let's say sellers are stepping in right here with limit orders. They get stopped out right away. And how do they get rid of their orders? Because they have sell orders, right? They have to buy back from the market. And where do they have to do this? At their stop level. And let's say your stop's up here. Like they have to do this at their stop level. Like this is where they have to buy back these orders from the market. So what's that going to do? It's going to accelerate the buy orders in the market because now there's a whole another group of sellers that were trying to sell right here because they thought, they saw this reaction off the high. Thought we were going to, come up into a fair value gap that was made and respect that and trade down. Like all these people that thought that was going to happen, oh, now they're getting trapped. Is the saying right here? They're trying to sell right here. They get trapped. They get stopped out right here. They have to buy back from the market. And what's buying going to do? It's going to push up the market and it's just going to accelerate the price action. So that's another confirmation you can get. Let's say if you're like looking for a continuation entry, and that logic works on reversals too. Like, people think the market's gonna keep going up because it hits this high, they place buys, retraces, hits the high again. People think if they break through again, like they have limit orders for buys, and it goes down. So it's the same logic, but just another important thing that's called trapped buyers and trapped sellers. And there's also exhaustion, which is a way more simple concept. It's just like the price is continuing, it's continuing higher like this. But if you look at the volume of buyers behind the price, like it's slowly dwindling, that's when you can expect the reversal to come in soon. And so that's kind of just like order flow. That's not even, I mean, that is what's happening when the market reverses, but not always. Yeah, so what else can I go over? And by the way, when a fair value gap is being made like this is an accurate representation of this volume here, but like when you're on like a 2 minute chart, like you're not gonna see this so cleanly. Like I'm just saying a lot of the time, like a lot of times when that's happening, like it's not going from high volume node to a low volume node, or sorry, and back to a high volume node. It's kind of just like there's way more aggressive buyers here than aggressive sellers for a second, and then like it can snap. Like when you're looking at the 1 minute chart or the 3 minute chart, um, that's not going to be the case a lot of the time. Like so, yeah. Don't just start getting super into volume analysis, especially if you're into intraday trading. Like I don't feel it's as effective, in that case. Yeah. So what other ICT concepts can I go over? Yeah, so for the inverse fair value gap, why it's important is because a lot of time price reacts out of these low volume nodes like buyers as I was saying, like buyers weren't wanted to get in right here, but weren't able to get in at this price. Like they believe this is a fair price. But in this market, you're not able to get in. And when you're creating fair value gaps, you know that it's an imbalanced market and looks more like this on the volume analysis. So when price returns, that's why you expect price to continue up. And the logic behind the inverse fair value gap, this is why it was made, by the way. The logic behind the inverse fair value gap is like you hit a high right here, you reverse, and you close. You get a closure, not just a wick below, you get a closure. That means price hit all these limit orders of people trying to buy, like hit all these limit orders, and the closure is important because if it's just a wick, that means it reacts and rejects off that level. But if you're able to close below this fair value gap, that means that like there's that many aggressive sellers that like these limit orders, uh, these sell orders got absorbed by buyers, and then all of them got absorbed, and then they still continued lower and closed below. So like you can't like just look for the to wick in and then think. You gotta wait for the closure of this. Let's say it's a 5 minute candle, for example, and at 2 minutes we're right here. You gotta wait for it to actually like hold and respect and accept level below this price. Let's say we're 2 minutes through that 5 minute candle, and then in the fourth, like you're like, oh, I'm gonna get in right here, like we're below this candle. No, you have to wait for that 5 minute closure because on the fifth minute we could close up here and just create a wick right here. So, um, the logic behind the inverse fair value gap is like limit orders will be placed here, and if we're able to get a full closure, we're accepting price below, and we can now start our downtrend after sweeping a high. So it's very solid logic, the inverse fair value gap, in my opinion. And that's kind of the same idea with the order block and like CISD. Like if you're hitting a high and you hit it, and this is like the last bearish move. So let's say the last bearish move before hitting the high. That's kind of the last point where you'd expect buyers, like if the market's going to continue up, you'd expect buyers to defend this level. This is an order block right here. Uh, because I obviously got a closure because it hit this high. So we have an order block right there. You're gonna expect buyers to defend this level, but if we get a closure below, then you can expect sellers to defend this level. And the order block that was made right here, which might be a closure right there. Now that's where you enter on a reversal. That first kind of, you know, exception of price to go lower, and then we kind of, accept these levels. So that's how you can use like all this. And I just think understanding like why are we reacting at these highs is the most important thing. Like what is actually happening when we have an SMT? Like orders are getting filled. You're hitting resting orders. You're hitting people that have placed like institutions. Did you know that institutions control 96% of the market? Like retail traders have nothing to do with this market. So all these people getting in market orders, like, and institutional traders, like they don't want to. They honestly can't get in market orders because it's just too much risk. Like that amount of slippage with that amount of money, like you can't risk that as an institutional trader. So that's really what's getting absorbed when you hit these key levels. Um, so yeah, that's kind of my lesson today. It's just like going over aggressive sellers, aggressive buyers, limit orders, market orders, um, what's happening at these highs and lows, like absorption. It's kind of like an order flow. It's going over order flow. I think understanding order flow will help with your understanding of ICT. And I got through the phase of like I was super into like wanting to combine ICT, order flow, and volume profiling, and like it's just too many confluences. Like it just confuses you more than it does any good. If I'm being completely honest, like you have a million levels marked out. You're looking for price to, and I'll say this, like with volume profile analysis, like if you get into that, it's like called the POC, and like that's where the most volume was traded, and like people expect like price to react off of it or to just get absorbed by it and like kind of stay in that range, and like people expect price to react off of low volume nodes. Like it's just too many areas. And intraday, you're constantly updating the volume that's happening inside the day. Like this could be the POC at the beginning of the day, but by the end of the day, the POC is up here, or that there's more high volume up here. Like it's just constantly updating through intraday. So I don't know. It's just hard to really use, in my opinion. If you look at like the previous week's POC, like maybe if it works out, you can take profit there. But at the end of the day, highs and lows being created in the market, right? These levels have the most liquidity, and you see reactions every single day at these levels, at highs and lows, not at like the POC. Like, what can you see literally every single day is price reacting at these levels. This is where institutional traders trade at these levels, at discount, at premium. Like, I'm telling you guys, that's the most. And if you want to be the most efficient trader and consistent trader, you got to look for the reactions off these highs and lows. And that's ICT right there. And you can hate all you want on ICT concepts, like it's just price action. You just call a fair value up ICT, like it's just price action. It's important and it tells a better story. Like what's happening here? We're disrespecting all these limit orders. Um and like there's so much going on with the order flow. Like there's limit orders placed here, but the amount of aggressive sellers are like outweighing. We're getting absorbed for a second. We're retracing, then we're coming back down because the aggressive sellers are stepping in, and it's outweighing the limit orders being placed for buyers. Like that's just too much analysis to do in a 5 minute candle in 2 minutes. Instead of we can just look at, oh, we had a fair value up here. Buyers might try to defend this level. Oh, we completely disrespect that level by closing below it. Uh, and if we just tapped into a relevant level, We got absorption, buyers into sellers, or sort of sellers into buyers. We can expect now the market to go bearish, and like that can all just be told from this inverse fair value gap. And like I honestly think some of these bankers that like say ICT is bullshit, I think they're dinosaurs, bro. Like we didn't have this data even 10 years ago. We didn't have trading view, guys. I mean, actually, I don't know how long trading view's been around. It's probably been around for 10 years. But like in the 1990s or whatever, when this shit was created, like we had a candle every 30 minutes updating us. And before that, it was like every day. So like all you could really trade, you could, at best like you could swing trade like over the week and like you could look at volume analysis. Like you, there wasn't even enough candles to really even make like relevant highs and lows. Like there were, but it's hard to trade and it's hard to see absorption at those levels. So like we're just price action. ICT is just adapting. It's adapting with the times. Like seriously, it's just keeping up with the times. Like we have this data, we're able to see this. You can see, you can, if you pay for it, you can get the 1 second candle. Like that's retarded, but like you can. That's the and that's the thing. Like, that's the truth. So it's the end of this yap, but I think this stuff's important to know to like just it just helps you understand the why behind things. Like I feel like for me, I need to learn the why behind something before I can fully understand it. And like learning volume profile and learning order flow like really helps me understand ICT confluences. Like what do we see today? Even on today's price action, what do we see? Price hits this low. This was a news low right here. Price hits this low. What do we see? We see a little retracement. We see it continue down again. So we know it's accepting price. It consolidates at, so like we know it's accepting price below this level, right? And what were we just talking about? Trading out of like, this is the inefficiency I was talking about. We're trading here. We're consolidating. We trade out of this inefficiency. Are we going to accept price at this level? Where is it? Where is it? There's our absorption. Are we going to reverse? Or are we going to accept price at this level and continue? I know I went over that. So if you see like, sellers or buyers get absorbed, but it isn't strong enough to create a reversal. Like we see a reaction, definitely we see a reaction at this low. Like buyer step in for a second. I'm sure I could pull up the CVD. Not really any divergences here, but uh like we can see a reaction at this level. And then just from price action, like we don't even need this shit. Just from price action, I can tell you price is accepting below and it's creating another CISD below this block. And then it's consolidating. And then while NQ is taking out more highs, like it's just accepting price and rejecting. It's coming back to this level and it's rejecting again. That's what I was just talking about, how we come back into a level and then now we can use it as rejection. Whereas if we were to come down and hit this key level and then retrace, so do the opposite. We hit the level and trade it through and then retrace. We were to hit the level, bounce off of it, and then come back down, then we would trade away. And that way we use a rejection. Whereas here, we hit it, come back, now we're using it as a rejection, and now we're going for a trade. And that's where we try to get in today, by the way. Well, we went break even too early. Fucking hell, mate. Look at trade two. So pissed at myself. On the 3 minute, I made my last video on this. The 3 minute right there. I thought that was a valid enough CISD, but I realize now we didn't get any retracement in this fair value gap, meaning it wasn't a CISD, so it couldn't be a protected swing high. So There's no reason to close. Some kind of fucking idiot, but whatever. Good trade nonetheless. Great execution. Or sorry, great model, not execution. But yeah, that's what I'm saying. Like about this stuff. Like once you understand volume and like understand order flow, like it accepts at this price and then like trades below. It's just gonna make things add up. It's gonna make things easier. So that's that. Thanks. Hope you learned something.